Are you tired of living paycheck to paycheck and want financial freedom? What if I told you you could build lasting wealth through trading, even if you're a beginner? Welcome to Optimal Wealth, your ultimate destination for unlocking the secrets to financial independence and building lasting wealth. In this video, I'll give you a comprehensive guide to trading to help you build long-lasting wealth. You will learn exactly what trading is, the basic terminologies used, how to start trading, and how to determine what assets to invest in. We will also cover the concepts of fundamental and technical analysis, developing a trading strategy, and managing your expectations. And be sure to watch to the end. We've saved the best for last. How to keep growing your wealth with trading. First of all, what is trading? Well, trading is simply the art of buying and selling financial assets to generate profits. These financial assets could be stocks, forex, or crypto, with your choice depending on what asset presents an opportunity to grow your investment. Now, what is the difference between these assets? On their part, stocks represent ownership in a company and are traded on stock exchanges. Think the New York Stock Exchange, NYSE, NASDAQ, and London Stock Exchange, LSE. Forex is the short form for foreign exchange and is all about buying and selling currencies. Forex is the largest and most liquid market globally, allowing you to profit from changes in currency exchange rates. Finally, cryptocurrencies are digital currencies that use cryptography for secure transactions. Popular examples are Bitcoin, Ethereum, Dogecoin, and Shiba Inu, and you can profit from crypto by capitalizing on their price fluctuations. Moving ahead, what are some basic terminologies in the trading world? Bull market and bear market. On one hand, a bull market is when asset prices rise and investors are optimistic. On the other hand, a bear market implies falling prices and investor pessimism. Long and short. Going long means purchasing an asset with the expectation that its price will increase. Going short entails selling an asset while expecting its price to dip. Bid and ask. When you hear bid price, it means the highest price a buyer is ready to pay for an asset. As for the ask price, this is the least amount a seller is willing to accept. And while we're on these concepts, I'll let you know about the spread, which is the difference between the bid and ask prices. Volume. This is the total number of shares traded in a specific asset over a certain period. Volatility. This is the degree of price changes of an asset or overall market. On one hand, high volatility suggests significant price swings, while low volatility indicates relatively stable price movements. Stop loss and take profit. Stop loss is an order placed to automatically sell an asset when its price hits a particular level, thus preventing potential losses. Take profit is an order to automatically sell an asset when it hits a set profit. Margin and leverage. Margin is the amount of capital needed to open a leveraged position. Leverage allows you to control a larger position with a lesser amount of money, increasing profits and losses. Candlestick charts. These are graphical representations of price movements. Every candlestick offers details on the opening, closing, highest, and lowest prices within a specific period. Resistance and support. Resistance refers to a price point where selling pressure might overwhelm buying pressure, potentially causing the price to stall or reverse. On the other hand, support is a price point where buying pressure may outweigh selling pressure, potentially preventing the price from falling further. Diversification. This is yet another common term in the trading world, and it means spreading investments across different assets or markets to reduce risk. With the fundamental aspects out of the way, how do you actually start trading? Well, the practical side of trading entails two essential steps. These are: 1. Choosing a reliable broker or trading platform. Before we go on, a trading platform or broker is a service or software that allows you to buy and sell various financial assets. Choose the best trading platform for the best experience by doing your due diligence. In other words, research different brokers or trading platforms to find an established and reputable firm with a track record of reliable service and positive customer reviews. Is that all? Absolutely not. Other important considerations are platform features, financial assets offered, fees and commissions, and customer support. 2. Opening a trading account and funding it. After finding a brokerage platform that works for you, You must complete an application to open a trading account. This usually involves providing personal information, verifying your identity, and agreeing to the terms and conditions. With that done, fund your account using one of the available funding options. Often, these can include bank transfers, credit debit cards, e-wallets, or other payment methods. So, you now have an account. What assets should you trade? As mentioned, you can trade in stocks, currencies, crypto, bonds, and other financial instruments. But that's a massive range of options. So, to determine your specific trading asset, you need to, first, define your goals. This involves clarifying your financial objectives and investment goals. It is essential to have a clear picture of whether you seek long-term growth, short-term profits, income generation, or a combination thereof. Second, understand your risk tolerance. Some investment assets, for example like stocks, tend to be more volatile than bonds, which are more stable. Your risk tolerance refers to how comfortably you can cushion fluctuations in your investment's price without disrupting your lifestyle. After identifying your ideal trading assets, it's time to develop a trading strategy. How do you do it? So, developing a trading strategy is all about creating a personalized strategy that aligns with your risk tolerance and investment goals. There are different trading strategies you can use, including day trading. This is the purchasing and selling of assets within a single trading day. The point is to profit from short-term price fluctuations, taking advantage of intraday market volatility. Swing trading. It involves holding positions for a few days to weeks, aiming to capture short to medium-term price swings with an established trend. Long-term investing. It focuses on buying and holding assets over an extended period, typically several years or more. Now, throughout your trading, you must keep educating yourself by researching and conducting analysis. So let's talk about the common types of analysis you'll have to conduct. 1. Technical analysis. Traders widely use technical analysis tools to analyze price charts and identify potential entry and exit points in the financial markets. That said, when leveraging technical indicators, consider the following tips. Understand the strengths and limitations of each indicator. Avoid using too many indicators, leading to conflicting signals and analysis paralysis. Combine indicators that complement each other and provide confirmation signals. Consider the time frame you are trading and choose indicators that align with that time frame. Regularly review and adjust indicator settings to suit current market conditions. Use indicators in conjunction with other forms of analysis, such as fundamental analysis or market sentiment. 2. Fundamental analysis. Fundamental analysis involves examining various factors that can impact the value of an asset, such as economic conditions, industry trends, company financials, management quality, and competitive landscape. The goal is to determine whether an asset is overvalued or undervalued in relation to its true worth. Up next, how do you manage risk and expectations? Risk management techniques, for example, setting stop-loss orders and managing position sizes, are essential in trading. Setting stop-loss orders helps limit potential losses by exiting a trade if it moves against your position. Managing position sizes ensures you don't overexpose yourself to any trade or asset. Other essential risk management strategies are diversification and evaluating the risk-reward ratio. When it comes to managing your expectations, here are some important tips. Evaluate your trading decisions based on their alignment with your strategy rather than solely on short-term results. Accept that losses are part of trading. Take breaks and practice self-care to minimize stress. Continuously educate yourself and adapt. Now, to the important part. How do you continue building wealth through trading? Building wealth through trading involves strategic approaches to maximize profits and capitalize on compounding returns. Here are some tricks for scaling up trading activities and generating long-term wealth. Use advanced trading tools. Compound your returns by reinvesting profit. Join trading communities. Stay updated on market trends. Keep a trading journal to review and analyze trades, identify strengths, weaknesses, and areas for improvement. Consider seeking guidance from experienced traders or professional mentors who can provide personalized advice and insights. Now, what do you think about today's topic? Do you have something to add or question? Let me know in the comments section. While you're at it, hit the like button and share the video widely. Remember to subscribe and turn on notifications to get alerts for future videos. Thanks for watching.